Here's a mini lecture on Chapter 6. Chapter 6, we're going to cover in brief detail about interest rates, and it'll set the stage for some of our subsequent work. So first of all, what are 4 factors that affect the cost of money? The first is production opportunities. In other words, what are the available investment opportunities for different entities in productive assets? The second factor that affects the cost of money is time preferences for consumption. As a consumer, do you prefer to consume now, spend money now, or are you willing to save for future consumption? Of course, another factor that affects the cost of money is risk. We learned in an earlier chapter that risk is the chance that some unfavorable event will occur. In terms of finance, that unfavorable event would be either a low or a negative return. And finally, expected inflation. That's the amount by which prices increase over time. In other words, the general level of prices increase over time. We're going to first make the distinction between nominal and real rates of interest. We're going to say that R represents any nominal rate. In a previous chapter, we talked about nominal rates. A nominal rate is the rate that's stated or quoted on an investment. But here, we're also going to take into consideration R star. R star represents the real risk-free rate of interest. In other words, this would be the rate of return on an investment that had no risk and there was no inflation to consider. We're going to say that IP is an inflation premium and RF represents the risk-free rate of interest. So that leads us to the following, that R sub RF, the risk-free rate of interest, is equal to R star, the real risk-free rate of interest, plus IP, and inflation premium. So let's remember this formula. So here are various determinants of interest rates where a nominal rate is equal to R star plus IP, and we just said that this right here was equal to R sub F, the risk-free rate of interest, which we generally observe in our economy as the return on a treasury security. In the real world, the security that has the least amount of risk is a treasury security. So we're going to go ahead and use that as our risk-free rate. So the nominal rate that we observe on any security is going to be equal to the rate on a treasury security plus these other premiums. The default risk premium. That's how likely will an issuer honor his obligation. The more likely an issuer is to default, then the higher this premium will be. The liquidity premium is based on the marketability and trading frequency. In other words, can you sell this security and still maintain its fair market value? If it's not, well, then you have to add in a liquidity premium. And finally, the maturity risk premium is the risk associated with changes in interest rates and what effect that has on the price of a security. And there's an inverse relationship. As interest rates go up, the value of outstanding securities go down, and vice versa. So we can say that the nominal rate that we expect to observe on any security, on any investment, is going to be equal to the risk-free rate plus these premiums to take into consideration. Is there a default possibility on the issuer's part? Is it hard to liquidate that security? In other words, is there a secondary market for it? And what about the maturity risk premium? That the value of the security will change as interest rates change, and long-term securities are more sensitive to changes in interest rates than short-term securities. So when we look at different types of debt securities, are we going to add in these different premiums? Well, when it comes to whether we're talking about treasuries, whether on the short term or the long term, or corporate, an inflation premium is added in to all of their returns. When it comes to the maturity risk premium, remember, we said that had to do with changes in interest rates. When interest rates go in one direction, value goes in another. There's an inverse relationship. And long-term securities are more sensitive to changes in interest rates. So the long-term securities, whether they're issued by the U.S. Treasury or by corporations, both have to have a maturity risk premium built into their returns. What about the default risk premium? In other words, how likely will the issuer honor the obligation? Well, Treasury securities, whether short-term or long-term, we said they are the closest things that we have to risk-free securities. So we don't have to worry about the default risk premium for treasuries, but for securities issued by corporations, there's always the possibility that those corporations could go belly up and not honor their securities. And finally, what about liquidity? Liquidity, remember, has to do with by selling, by being able to sell something and still maintain its market value. Well, whether or not it has a good secondary market. Well, Treasury securities, whether they're long-term or short-term, are extremely liquid. There's always a market for these while maintaining value. So you don't have to worry about adding in a liquidity premium. But for corporations, that's an issue. For any issuance of a security by a corporation, you got to worry about that. So inflation premiums, all of these forms of securities have to have a built-in inflation premium in their nominal rate of return. Maturity risk premium, anything that's long-term. Default, we got to worry about that. So you got to add in a premium to the nominal rate for corporations. Likewise, liquidity premiums as well. When we talk about interest rates, a topic that always comes up is this topic of the yield curve. What's the yield curve? The yield curve shows the relationship between interest rates and the maturities on various securities. Okay, so the yield curve is just the graph of the term structure of interest rates. So in this case, here's an example of a yield curve. It's upward sloping. What that means that short-term securities at that point in time have a lower interest rate than long-term securities. See, because it's upward sloping. 10-year securities only have an interest rate of about 0.75%, but a 30-year security has a higher interest rate, closer to 1. So that's an upward sloping yield curve. We can have a flat yield curve where the maturity doesn't make a difference, or we could have a downward sloping yield curve where short-term securities have a higher interest rate than long-term securities. Most of the time, we observe an upward sloping yield curve where longer-term securities have higher interest rates attached to them. And the last thing we want to cover in Chapter 6, talk a little bit about the macroeconomic factors that influence interest rate levels. The first, of course, is the Federal Reserve policy. The Federal Reserve, as you probably remember from your economics classes, that the Federal Reserve has a huge impact on our money supply because they conduct open market operations. The Federal Reserve will buy Treasury securities when it wants to expand the money supply. In other words, it's putting money into the hands of the public. In those cases, or in that instance, interest rates fall. When the Federal Reserve sells Treasury securities to the public, it's going to be contracting the money supply. In other words, it's taking money out of the hands of the public. In that case, interest rates go up. Now, another factor that affects the level of interest rates is the federal budget deficits or surpluses. When we have a deficit, the Federal Reserve will have to sell more Treasury securities, and interest rates will eventually go up. We know that with this huge infrastructure bill that will cost trillions of dollars, chances are that it's going to have a huge effect on our interest rates. On the other hand, when the federal budget has a surplus, the Federal Reserve will buy bonds from the public, will buy Treasury securities from the public, and interest rates will then go down. International factors, what's going on internationally, and the international economy will have an effect on interest rates as well, and even the level of business activity will have an effect. For instance, in 2000, both international factors and level of business activity, in 2008, we had the global financial meltdown. Our economy became very, very weak. So the Federal Reserve instituted what was called quantitative easing, where they continually bought Treasury securities to put money in the hands of the public and keeping interest rates very low. And interest rates are still at a very low level. But the way that things are going in the US economy and internationally, due to a variety of things, the comeback from the coronavirus pandemic, supply chain factors, there is a huge risk of inflation. So there may come a point where the Federal Reserve will have to start selling Treasury securities to take money out of the hands of the public and increasing interest rates to slow down inflation. We shall see. So that's all I wanted to speak about regarding Chapter 6. This should allow you to get through the homework, the problem set, and mindset, and mind